Hello, and welcome to today's webinar about what to do with extra cash. I'm Jessie Dolmage, the moderator and an associate planner here at Arnold and Moat Wealth Management. Matt Hilland, who you just heard speaking, he's a planner and a partner at the firm and will be presenting today's webinar. Before we begin, though, just a couple of quick reminders. First, during the presentation, please remain on mute, but at any time, feel free to type questions into the chat box. We'll answer any of those at the end. Although if you prefer, let us know if you'd like to schedule a meeting to discuss your questions privately. We're happy to do that. And second, if you have any suggested topics for future webinars, we'd love to hear them. Just drop us an email, or you can even contact us through our website. So that said, let's begin today's webinar. This is a topic we've been talking a lot more with clients about recently, and that's what to do with extra cash. We're going to talk about your different options and our thoughts on which are potentially better options for you and ones that we might not recommend. So without further ado, here is your presenter, Matt.
All right. Thanks, Jessie, and thanks for everyone for joining us today on your Friday afternoon. As Jessie said, this is a topic that has come up from several client questions and comments, and then just kind of seen general increased interest about what to do with cash in today's, kind of really low interest rate environment. And so we structured this webinar in kind of two main sections. First, we're just going to look at some basic options for cash today. We'll look at some of the pros and cons of various options like money markets or CDs or savings bonds, to hopefully give you a little bit better idea on kind of the best choice for you. And then after that, we'll kind of step back a little bit and consider, questions more like how much cash should you have, when to think about, investing maybe instead of keeping stuff, like keeping savings in cash. Cash certainly has its place, but as you can imagine, if you were, only to use cash to save for your entire retirement, it's going to be pretty much impossible. And so where is that kind of break even on where cash belongs in your retirement planning? And so just getting started here, if this is a webinar topic that resonated with you, you're certainly not alone. The news has been pretty heavily recently covering the topic that consumers in general are just flush with cash. And we know this partially because the Federal Reserve actually keeps track of this data. And so this is just a chart showing deposits in the US banking system. And, there's a pretty clear jump here starting about 2020 when a lot of people kind of realized that they just had extra cash and wondering what to do with it. With the coronavirus pandemic, consumers as a whole have added about $2.5 trillion to their cash piles just in the last year and a half or so. And so, so if you're part of this $2.5 trillion, what are your options? And the first thing a lot of people jump to is just kind of a simple high yield savings account. These have been really popular lately. And, that's because until about a year ago, banks were actually really fighting for market share in this space. And so some were really offering some really good interest rates. I think everyone here is familiar with the concept of a savings account, so I'm not going to go through all the details, but these high yield savings accounts come with two caveats that I think are just important to think about before moving your cash over. And first, the best rates seem to be with online only banks. And so if you like having a bank branch you can visit, a banker to talk to, you'll have to decide if, an increase in interest rate on your savings is important to you and worth sacrificing, maybe not having a local branch. And more importantly, it's really important to understand that the rates that are advertised for these high yield accounts are never locked in and can change at a moment's notice. Right now, banks aren't really competing for deposits, but a couple of years ago, they really were. And you saw a lot of really good specials for high interest rates. But as a lot of people found out, that those high interest rates just really didn't last very long. And just for example, this is a screenshot from Marcus Bank, which is owned by Goldman Sachs. They were a new entrant to online banking just a few years ago, and they really came out with some high interest rates when they launched to attract some new customers. And so this was February 2019. They were advertising in really big print on their homepage, rates like 2.25%. And many billions of dollars flowed into, Marcus Bank very quickly because this rate was very competitive. But that rate really didn't last long. Today, their interest rate's down to about 0.5%, and maybe not terrible compared to some other banks, but most people did not get that 2.25% rate that is kind of advertised even for a year, because that 2.25% interest rate was cut down to about 1% in early 2020, reduced a few more times through 2022 to kind of arrive where it was today. And so that's just one risk with kind of yield chasing amongst some of these high yield savings accounts. Ally Bank is another really popular online one. A few of the other, American Express, Discover, all kind of have these types of accounts. And it's just important to know that if you want to always have the highest rate out there, it's going to mean constantly shopping around and maybe moving these accounts, which can be a little bit more of a hassle than you may be intended. That said, even at this 0.5% interest rate, that Marcus Bank, just for example, has today, that's probably better than a lot of people are getting in a savings account at Wells Fargo or Bank of America. And so they can still be a good deal. Just have to know that that can always change. CDs are another thing that I think everyone is familiar with. I'm not going to go through all the details. But just a couple things to consider is that, it can be either a pro or a con to lock your rate in with these CDs. And if you get in before interest rates fall significantly, CDs can be a really great option. But of course, it's just kind of luck with timing. And, if you get in before rates rise, you're stuck in a much lower interest rate, account than you would be otherwise. And you're forced to either pay the penalty and break your CD or just hold it until it matures. And so just one thing, of course, to keep in mind, if you're worried about inflation, for example, getting into a longer term CD is probably one of the worst ideas of the options that we'll go through today. And nationally, CD rates right now are just really low, under 0.5%, that we looked at earlier, unless you want to get out to many years, 7+ years before you can start getting that 0.5% consistently. However, locally, we are seeing a little bit higher rates for whatever reason. This is just an image from our CD rate sheet that Nick puts together each month, and we have linked to in the last couple of newsletters. Where CDs can still be valuable is a lot of these special rates that banks offer just to try to attract new customers or new money. That's the right side of this image here, where we show some local banks, what they're offering for specials. And just for example, Green State's offering about 0.8% right now for about a 1 or 2 year CD. And that's probably more than you're going to earn, even with some high yield, online checking or savings, or certainly more than a bank account. And so we're always happy to help you shop around for CDs if this is something, an investment that does interest you. And then periodically in our newsletter, we're going to link to this as well, just so you can kind of keep up to speed. But please reach out if this is something we can help you kind of shop around for. Another option that I think most people are familiar with is money markets. The big difference in money markets compared to those last few options we've discussed is that money markets are actually investing in something. And so money markets buy really short-term debt, usually debt due in 60 days or less. And this leads to a few differences from how they operate compared to some of the other savings accounts that we just brought up. First, kind of as a pro here, interest rates for money markets tend to respond to rising interest rates much faster than anything else we're going to mention here. And that's because, again, the interest rates are really tracking what companies are actually paying to borrow. And those loans are really short term. And so they're getting reinvested regularly into, higher yielding loans as interest rates rise. And so at a time when a lot of people are worried about inflation, even though rates for money market funds are low today, some might make that trade-off knowing they're not locked into something with a fixed rate like a CD and has something that has the potential to kind of rise a little bit faster than maybe a bank savings account or something else we'll talk about today. However, because money markets are actually making investments, that means there's technically some risk in these, and it's rare, but 2008 and 2009 saw a really big stress on money market funds and actually, led to a panic and kind of a run on the bank for many of these funds. I had a snippet here of just the news article as the New York Times covered it in 2008. But that crisis really ignited a big outflow in the money markets and actually forced the government to jump in and temporarily guarantee, a couple of these trillions of dollars in money markets to stop the panic. And so today that guarantee on these no longer exists for most money markets. And there was some legislation enacted that changed how these money market funds operate. And so this might be important if a money market's something that interests you. There's three main types of money markets now. And it might be important just to know what you're buying if this is something that interests you. And so the first type of money market and the biggest, kind of most common is prime money markets. And that means it's investing mainly in corporate debt. So these are probably going to come with a little bit higher interest rates than the other type of money markets, but they technically have some risk and are not guaranteed. Government money market funds are required to primarily hold US government debt. I think it's 97% of the assets must be in US government debt. And so these are much safer because they own US government debt compared to corporate, but that safety brings down interest rates. And then lastly, municipal money market funds invest in municipal securities. That might have a tax benefit for some by not being subject to federal or state taxes. But, with that comes even lower interest rates because a lot of very wealthy people that have a lot of money to invest are using these to save on taxes. And so, money markets have historically been really popular, but right now they literally have the problem of having too much cash. A big portion of that $2.5 trillion in extra cash has flown into these money markets. And so right now, interest rates are very close to zero, just incredibly low. If rates rise, that should correct itself a little bit, but there's no real telling on when that would be. And lastly, I'll just say that money markets have changed quite a bit because of the financial crisis. They're now regulated very differently, and they haven't really had a chance to operate in a high interest rate environment. And so, as I said, these were really popular investments in maybe the year 2000 or so. They're real notable for getting 7 or 8% interest. And there's just not a guarantee in my mind that they'll return to that kind of level of interest rate because of that added regulation that they have now. But they're still a very popular investment and a very good way for large amount of money to save. Moving on to the next part, if we introduce anything new in this webinar, I think it might be I-bonds. These are floating rate savings bonds that are issued by the US government and guaranteed by the US government to have an interest rate that's pegged to inflation. These are similar to those, orange EE savings bonds that it seems like everyone grew up with, but they're a different series that work a little bit differently. And the first thing that will probably jump out to you on this slide is the interest rates that these currently offer. I-bonds currently pay about 3.5%, which is, many multiples higher than anything else we've discussed so far. And, that makes I-bonds a great place for cash savings right now. But they come with a couple features that you should know about that can make owning these, a little bit complicated or restrictive. And the first is that while that 3.5% interest rate looks really good right now, that rate resets every 6 months. And so if inflation does die down, the interest rates on these can and have historically gone down as low as zero. And so that 3.5% is really just guaranteed for 6 months. After that, it just depends on the market. Also, once you buy an I bond, you must hold it for at least a year. And it's not, even like a CD where there's a penalty for selling in less than a year. It's that you simply cannot sell them, in less than a year time frame. And so it might take a little bit of planning to ensure you're comfortable parting ways with that money for at least a year. And there's also a limit on how much in I bonds you can buy in any single year. Each individual is allowed $10,000 per year in I bonds to purchase. That means a married couple can buy $20,000. There might be some creative ways to have minors, if you have kids, be able to own these as well. That could increase your annual amount a little bit. This can come with some tax complications though. So you should, just ask us if this is something you're really interested in. But in general, kind of converting a large amount of savings to I bonds just takes some planning and requires, at least a few years to kind of implement. And all that said, though, if you can work around these caveats right now, the interest rates on I bonds are the best you'll find, certainly for any, US government guaranteed interest rate. And if we can help you with these, with buying these, just reach out and let us know. They're a little bit more complicated. We can't do this at Schwab. This is something you would have to create an account with, actually at the Treasury. It's treasurydirect.gov, and buy them through an individual account there. But again, if we can help you, if this is something you're interested in, please reach out and let us know. One other really important really popular investment lately that we've fielded a lot of questions about from our clients is TIPS, and these are Treasury inflation protected securities. These are Treasury bonds that have an inflation adjustment, and a lot of people kind of think in their mind that these work just like I bonds, but they can really be quite different. For starters, these TIPS are not really designed to be short-term savings vehicles. And if you think about it, that's because in general, inflation is usually not a big impact for really short time periods, a year or less. Inflation can make a big impact over decades or more, and that's what TIPS are really designed to protect against. And so, something like a 1-year TIP doesn't exist. I think 7 or 10 years is the shortest you can find if you're buying these, on the primary market. If you buy one of these with the intent just to hold for a short period of time, you can actually lose a good chunk of money. TIPS have had several double-digit percentage drawdowns at any time, as this chart here shows. And while government guarantees that the original owner of these bonds will not lose money over, a 10+ year holding period, there's no guarantee that if you sell these before they mature, that you will not lose money. And so, these tend to be a lot more volatile than what people want to see with savings, with just cash savings. Seeing, your bank account drop by 10% would startle a lot of people, and that's what these TIPS can do somewhat regularly. And then also know that right now TIPS have really negative interest rates. And so we've discussed this in other webinars. Our inflation webinar talked about these in a little bit more detail. But if you plan on holding these for a short period of time, it's very likely you could lose money if we don't get a big spike in inflation just in the next year or so. And so for shorter term time periods, TIPS are really something we would caution against using. And so now going from just discussing some of the options that you have for cash and looking at a little bit bigger picture, and that's just looking at questions like, how much cash should I have? And so I think the initial question to some of these headlines is like, is it really a problem to have too much cash? I think it falls into a category of a good problem to have, but we can see that it actually can end up being a problem if that cash makes up a portion of what you need for long-term retirement savings. And that's just because while cash is nice in the respect that it's very stable in value, it also does not do a good job of maintaining purchasing power over long periods of time in your retirement. And I like this chart on the right side here that breaks down how different types of expenses have increased over the last 20 years. And notice that whether you're a retired couple or a young family, there's some major expenses here that have seen really high inflation, much more than just kind of the normal level of inflation. And for retirees, that healthcare, which is, also tends to be one of the largest expenses in retirement, is also the portion of expenses that have really been rising at some of the highest levels. And a big part of retirement planning is to make sure you have enough money for the next couple of decades for your retirement. And so imagine knowing that you need, for example, $38,000 in today's dollars, 20 years in the future. But if you just want to use cash that you have today and set that aside for future healthcare needs, you're going to need about triple that amount of money just because of that inflation. And so just for example, $38,000 in today's dollars would be about $115,000 in 20 years from now if we see that same kind of inflation in medical expenses. And so when we start to think about needing to set aside $115,000 today for every year of your retirement, it starts to kind of show that just using cash or even just a large portion of cash to fund retirement expenses can get pretty hard. And, maybe that's an extreme example. We know no one has, 100% cash in their retirement accounts, but we do often see, pretty high allocations of people's net worth in cash or very low earning investments. And that can have an impact in kind of long-term retirement projections. And so we know everyone's different here. Some are very happy to keep a larger amount of cash, even knowing that it has a lower return. One thing we just like to make sure is that, we can kind of look at your long-term retirement with the software that we have. Many of you might be familiar with just this screen here, kind of our Monte Carlo estimating, the long-term likelihood of success of your investments, factoring in certain growth rates, factoring in inflation, and at least make sure that the cash that you want to hold is not setting you up for potential difficulty later by not being able to maintain the purchasing power of your savings. And so that brings us to maybe one last question here, and that's, how do you decide when to keep money in cash? How do you decide when to keep money in cash and when to maybe invest that money into something like stocks and bonds that has historically had growth that would keep up with, inflation that we've seen in medical expenses, for example? And, some other examples might be if you're saving for a home down payment or a retirement home or a new vehicle, when should you use cash? When should you use your investments? And we know from the last few slides that cash is not a great long-term investment when looking at longer term, just because of inflation. And investing that money has a lot of benefits and mainly growth. But what's worrisome about investing is the volatility. And so I thought it'd be interesting here just to show how a relatively conservative allocation of 50% stocks, 50% bonds has performed in some of the worst periods in stock market history, to give you an idea of the potential risk for investing cash or an investment that you want to be safe. And what I think is worth focusing on in this table here is the drawdowns that a 50-50 portfolio has experienced over the last 50 years. And so what this table is showing is different dates, different time periods where some of these might jump out to you as pretty notable for stock market declines or inflation, tech bubble bursting here in 2000. And the very right column, the underwater period, is how long you would have had to wait to see a 50-50 investment portfolio come back to break even. And, while there is certainly volatility in this, I think it's a little bit surprising for a lot of people on how even in some of the worst, literally the worst periods we've seen in the last 50 years, a 50-50 allocation was only underwater for about 3 years. And again, this is just a couple times in the last 50 years that that's happened. And so I think, maybe this is the start of kind of some framework for when to invest, when to save in shorter term assets like cash. And, if you're looking at a period of 3 years or so, there's technically been some risk in losing money in that short term of a time period. But in longer terms, the performance or the potential for growth on those investments has really taken over. And so this is a chart then of the performance of that 50-50 allocation over certain rolling periods. And so just for example, in any given 1 year period, that 50-50 portfolio has averaged about 9.8% return. It's been as high as 51% historically, and of course, as low as minus 22%. This is why if we know you need a very large expense next year, we're not going to advocate investing a large portion of that simply because there's a chance of losing some money, which might not be good. But over longer periods of time, say 5 years, for example, a 50-50 portfolio has never had a negative return over a 5-year period. And so just good, I think a good way to think about when to invest, that trade-off between volatility and return, and when to start thinking about, using that cash, moving that cash into investments instead of just remaining in a really low yielding investment like cash or a money market. And so I just wanted to end with something that I don't think a lot of people really think about, kind of piggybacking on that last slide. Everyone's worried about stock market volatility. It's why, we know a lot of people keep a large portion of money in cash, but over long periods of time, the growth is really needed on your investments. And a lot of people just kind of don't think about the certainty of effectively losing money in cash over long periods of time. And so this chart just shows the purchasing power of a dollar with various inflation rates over a long period of time. And, as we showed in that last slide, a 50-50 portfolio has never had a negative 5-year return. With cash, with today's inflation rates, you're guaranteed to have a negative return on cash. And so just to kind of help you think about, again, another way to think about the long-term impacts of holding too much cash. And so just some rules of thumb here. Again, there's no exact answer. Everyone's a little bit different in how much risk they want to take on their personal situation, but just some general rules of thumb for how much cash to kind of think about as a baseline you should have. In general, working, maybe like dual income, younger couple can have a little bit less in savings simply because, there's income, there's money coming in every month, there's 2 separate sources of income. And so, somewhere around 6-month living expenses is generally, kind of the baseline there. If you're in a 1-income household, you might want to go a little bit more than that. But in general, that'll get you in a very safe place, have something to fall back on, but making sure that you're also investing some of that extra money then, because when you're young, you want that invested. You don't want to keep too much in cash. For retirees, that changes a little bit. You no longer have an income to fall back on. And what we do for clients where we're managing assets is in general, keep 12 to 18 months of the withdrawals in cash or short-term bonds or money markets, just to make sure that's safe, set aside in case the stock market goes down. We want to have a very stable bank there to draw from. And so this is not necessarily 12 to 18 months of your living expenses. A lot of retirees have Social Security or pensions or other sources of income. This would be 12 to 18 months of the withdrawals from your retirement accounts, just to protect you from needing to withdraw when the stock market really goes down. And then just, of course, any short-term goals are always going to add to this too. And so, kind of using that 3-year time period that we talked about, if you're going to be buying a house in a couple of years, you would obviously add to this, add that down payment savings or something like that. And so I hope this might have turned into a little bit longer of a webinar. Thanks for sticking with us here. Please let us know if you have questions. We know this has been a really popular topic. We just wanted to give you a couple topics to think about, hopefully give you some ideas on maybe some of the better options out there for savings and some things maybe to avoid right now. And then hopefully give you some confidence too, if you're sitting on a lot of cash, knowing that, if it's for longer term things like retirement, to feel a little safer investing that, and, hopefully realize there's an importance in investing that too. So if there's no questions or anything, have a great weekend. Thanks again for joining us.